Again, and welcome to this afternoon session. This afternoon we'll talk about attracting institutional investors to Philippine PPPs, creating a suitable environment for infrastructure investment. We have a panel composed of experts to explore what the ideal environment would be for institutional investors to come here and participate in our PPPs in the Philippines. We'll identify regulatory hurdles and how government can address them. We'll assess the level of risks that institutional investors will be willing to take for these projects to be able to, for them to participate as direct lenders, possibly providing long-term tenor. We have with us this afternoon, as I said, a panel of experts to talk about this. Our lead panel member is Mr. Manuel, Managing Director for Asia of Sun Life Investment Management. He's, as I said, the current Managing Director of the Asia arm of Sun Life Management, providing tactical direction with respect to management of the life insurance, mutual funds, and pension fund assets in the Philippines, Hong Kong, and Indonesia. I'll allow our moderator, Mr. Dan Brown of DLA Piper, to introduce the rest of the panel.
As you may have heard, my name is Dan Brown, and if you've had an opportunity to look through your running sheet for today, you probably noticed that I'm not as good looking nor as charming as a man named Alex Guy, who's meant to be moderating the sessions. Alex gives his apologies. He's currently closing a PPP deal down in New Zealand. And I might just say quickly from the outset that I've had the absolute privilege of working with DLA Piper on the last 7 PPP projects that have been led here in the Philippines, both for the public sector and the private sector. And I'm also very grateful to have this opportunity to moderate this session today. I also noticed that we've gotten rid of the tables here, so I guess it's lucky that I've got matching socks on. So in terms of our panel of esteemed guests here today, we have to my left Alex Brogy, who's the Director of Project and Export Finance for HSBC. We then have Mr. Manuel, he's the Managing Director of Sun Life Investment Management. We have Mr. Robert Vergara, who's the President and General Manager of Government Service Insurance System. And then we have, last but not least, Ms. Vida Chiong, who's the Deputy Commissioner of the Insurance Commission of the Philippines. And so what we might do to kick off today is I'll hand over to Mike to have some opening comments in relation to the session. Thank you.
Okay, good afternoon to everyone. I'd like to speak based on my own experience with regards to infrastructure and the infrastructure story of Sun Life, not only here in the Philippines, but globally. So from a comparison perspective, so that I may be able to give you sort of a flavor why our participation in infrastructure projects down here in Manila is at much, much lower than how our experience is in North America. So in 2010, the then global CEO of Sun Life, Ron Stewart, actually had an audience with the Philippine President, new Philippine President, then Manuel. And he did make a promise that we will be participating in infrastructure projects here in the Philippines. The succeeding president of Sun Life, Dean Conner, made that same promise. And then 4 years hence, we are still to make any meaningful investments in infrastructure in the Philippines. And so I guess from the title of the panel itself, attracting institutional investors into Philippine infrastructure, our own experience in the company could probably give you a snapshot of what the hurdles have been, what can we learn from that, how we as a whole group, public and private, can somehow collaborate and bring, as someone had mentioned earlier, bring this from a presentation into action. So I would say from a public-private partnership perspective, we did have a lot of discussions way back. We've seen the deck of projects maybe 3 or 4 years ago. And we actually had met with Jose way back then. And we said, the possible financiers of projects on a long-term basis, much like insurance companies and pension funds, don't have access to the project proponents. The project proponents, once they go into bidding, already have a financial package backing them up. But then again, in a lot of the discussions, most of the financing will be 10 or 12 years. And you are giving out concessions of 20, even 30 years. And therefore, at some point in time, those will fall short. While we, on the insurance and pensions space, naturally latch on to 20, 30-year deals. In Canada, we even have 37-year deals financing infrastructure projects. And therefore, from that perspective, I think there is a lot that can be done from the private-public discussion, much like this, and I think this is a very good start. If you look at our Canadian books, it's about $100 billion of insurance money, $25 billion in private debt, and about $15 billion in infrastructure debt. We're building roads, airports, ports, and funny as it may seem, we have financed jails in Canada. In fact, in one of my practicums in Canada, they said maybe it would be good for you to be a jail warden for 2 weeks so that you can actually just feel what you have funded. In that sense, our North American books is illiquid. We are into private debt, commercial mortgages, real estate, and private equity. About 50% of the book is into those asset classes, backing up long-term liabilities that we write. In the case of Asia, in contrast, we're about 95% in government securities. So you know how much of the books in Asia, or even the books in the Philippines, can be migrated to an infrastructure debt, private debt type of exposure, where obviously we can get longer and we can get more spreads. What are the hurdles that I have seen in that migration? Right? One is that in North America, we have 60 people out of 200 that we employ in investments, just managing infrastructure debt and private debt. We don't have the same expertise that we have down here, particularly in Manila. So when corporate office would say, who has vetted on the technicals of the project? Who has vetted on the legal? Who has vetted on the insurance coverage of the project? There is no one particular person in Sun Life that may be able to do so. And therefore, we are relying on third parties to provide us that. And therefore, from that perspective, another PPP might arise. It's a private and private partnership. Because I need you guys to give me private advice, private consulting, because the expertise does not lie here in Asia, at least from our own personal perspective. We've talked to banks. They would say, well, we have tranches of 10 years, 12 years. And we would say, maybe we can do 20 years, even 25 years. And sometimes you do go straight to the project proponents and say, you know, we'll put on the table 20, 25 years, bullets. And they would chop up and down and say, wow, that's great for me. But then again, the question is, how do I package that? I don't have the expertise. And maybe, again, from a banking perspective, or the investment bankers out here, it can be another private discussion. It's another PPP discussion, right? From a public perspective, I would say there is still a lot of things that need to be discussed. We had visited the Insurance Commission about 3 weeks ago trying to find out what the risk-based charge for an infrastructure project will be. Because as the RBC framework stands today, there are very few asset classes that have a particular risk-based charge attached to it. A government bond is 0, a corporate bond is 1.6%, and then you have a big jump all of a sudden, which is other loans, 30%. So if it's not a government bond, it's not a corporate bond, and it's a project finance deal, do I get charged 30%, and therefore the economics of the project don't necessarily work. But without, and I know from the Deputy Insurance Commissioner that they are working on an RBC framework now that which will include that. I do hope that finishes fast. I think there's also a discussion between us and the Insurance Commission about, what is your experience somewhere out there in North America. And so it's another public-private partnership, not necessarily on a project basis, but on the underpinnings of what supports those projects. So imagine us going into a 20-year deal, having both interest and spreads, but not knowing what the capital charge will be. And therefore, it's very hard to have a discussion, come to a conclusion with a very important variable remaining as X. So I think that's another discussion that I think we'll have to move forward. So I would say there are a lot of things that yet need to be done. From a public-private perspective, I think risk-based capital frameworks, the swap markets itself, we do encounter a lot of discussions about, the funding on a greenfield project is mostly in dollars, but the liability portfolio of insurance companies would mostly be in pesos. So I deal on a, say, okay, I'm comfortable with a 15-year dollar loan. How do I swap that back into peso when I can swap it back in 3-month terms, 6-month terms, 1-year terms, and then thereafter the swap markets will not support me as much. And so I think those are discussions that need to foster moving forward. From a private perspective, I think that the banking sector does a lot of things from a perspective of project finance, and I do necessarily see buckets of financing, some as short as 5, some 10 to 12, but rarely would the banks go more than 15. And rarely have I seen 15, but mostly, insurance companies like us are very comfortable 20, 25. How do we get into that space without necessarily doing it on our own? How can we be as partners to any of the local banks providing project financing that we can get to the longer end of the market? So I think there's a lot of discussions that need to happen with the public sector, between public and public regulators, and between private companies like us with other private companies.
Thank you, Mike. And I guess before we move on to the other panelists, putting aside for one moment the risk-based charge issue, putting aside the swap FX arrangements, and also, I guess, the internal resourcing to actually deliver these projects for Sun Life. If we're looking at, and I guess they're more sort of a regulatory or structural, maybe not impediment, but challenge. If we get down to a project level basis and we're looking at the deals themselves that have been coming to market, what are perhaps some of the other challenges that you think might be faced for Sun Life if they were to participate in a project, perhaps on a risk allocation basis?
I would say, and I suppose it boils down to, again, the internal capacity here in Manila to somehow see how the risk will be done. In essence, we have to deal a lot with North American people who we think on a technical basis would have the expertise, but they don't necessarily have the flavor of Asia. Right? So when they calculate risk, they will calculate it based on their technical capacity to look at a particular project. But then again, once it becomes a question of politics, it becomes a question of legalities, then you see a big implosion about how much do I have to provide for this. I'm not aware about the stability of politics in Asia, changes in the administration in the Philippines. I don't know about the enforcement of default in Manila or somewhere else in Asia. How much do I have to put in? So from that perspective, somehow things grind to a halt as well.
Thank you. Robert, I guess we've heard from Sun Life's perspective about some of the broader considerations about entering the PPP market here. I'd be really interested to hear from your perspective what you see as some of the criteria or issues with entering the market from your perspective.
Well, we've entered the market. I think everybody knows that GSIS raised probably the biggest fund ever raised for Philippine infrastructure in 2012. It was a $625 million fund that was supposed to go not into debt, but into the actual equity of the infrastructure projects. And 3 years on, we're 64% invested. I think we're looking at a few deals in the pipeline. And I think the time's coming when we have to step back and reassess to see whether we reload and deploy more into the space, or whether we want to see now how the investments pan out and whether the promised or expected returns are actually delivered. At the end of the day, our interest in infrastructure is driven by the needs of our investment thresholds. In 2010, when interest rates were still north of 8%, it was very easy to meet the actuarial liabilities of GSS, which demanded that our investment portfolio generate an 8.25% annualized average return. Now that we're in an environment that looks like it is something that will stay because it's in the normal. Interest rates are around 3 to 4%, the Philippines, and negative in Europe. We really need to look at how we can diversify our investments to generate that return. We did not have to take much convincing to enter this space. I think it was a natural fit. I think Mike has said, our liabilities, our investment horizons, and the characteristics of infrastructure are really synchronized. So they really match each other. I think the decision was, if we were to go down this investment, how do we do it? And very quickly we looked at each other on Zoom and discovered that there was no expertise within GSIS to actually review, recommend, vet projects, much less to implement an investment and operate. And we decided that the best way to do it was not to invent it at home. There are various people out there, various firms that specialize in this area. And what we did was run a selection process which involved the other investors in the fund. So we had, at that time, the IFC and the APP, all very familiar with these types of projects, helping us with the process. It took about 9 months to single out who would be the one to manage the fund. And we have really given them complete independence in terms of evaluating and determining which projects we would invest in. Now the question is, what have they encountered in terms of the difficulties getting invested? I think what Mike has mentioned as far as the practical aspects of it that come out. We have laws which require minimum ownership, which require management to be invested in the hands of nationals. There's been a lot of maybe approvals that have taken much longer before they were actually granted to projects that have been already bid out. But it's all part of a learning process. And I think what you're seeing right now is that the first maybe 2 or 3 years, while it looked like it might have dragged, we are getting a much swifter process of bidding out. We've learned from mistakes. And in fact, from having no investments in the first 2 years, we suddenly are 2/3 of the way invested on the way to getting fully invested. So I think it's just for something that's been quite new for us to do. We had to make sure that we're very comfortable with the process. And I think that learning has taken place. And hopefully we will see that many of the things that the center has announced is going to be out for bidding. We really get to that stage.
It's great. It sounds like it's been a very busy period of time for you guys in terms of doing.
Yeah, I mean the pipeline is full. Our team is just continuing to go through projects. It's really just selecting the type of project which also diversifies our risk away from what we've already invested in.
Thank you. Alex, I'd really be interested to hear your thoughts on, I guess, the challenges but also the opportunities that you see in the PPP space for institutions.
Sorry. I mean, we're a bank, but in the Philippines, because of the liquidity and the commission from the local bank, we tend to come more in the PPP at this time. As of now, as advisors, so we come in and we have the private sector to prepare for the bids and then to raise financings, which allow us to consider all the options for funding. So that's local banks, that's for the equity portion of it. But then what we identified is there's a bit of a gap in the middle in terms of tenor. The local bank giving us 10, 12, potentially 15 years. But for infrastructure project, we really love to have that piece about 20-year money, potentially more when you have a concession of 30 or 35-year concession. One issue we face is that the rates, the benchmark rates from the local banks use for their funding has followed the government bond yield, so it's come down to very low levels. You can raise money 15 years potentially at 6% or thereabout for quality projects. Which means that even if you were to increase the tenor a bit to say 20 years, that might not necessarily meet the rates that some of the institutional would have. So you have that issue that the short-term money, so not short-term money, but medium to partly long-term money that the local banks have available is so cheap that there's actually no incentive for the private bidders for the project to actually go to seek that 20-25-year tenor. The issue from the local bank is that they give you, say, 15-year tenor for your loan, but there's an issue on the interest rate. They are not able to fix the interest rate for large amounts of money for this 15-year tenor. They insist on resetting the rates at some point in the middle, be it 5 years, 7 years, 10 years. It's just the way those banks get their funding. They've got deposits and all that. It's not the same funding as the institutional gets from the life insurance market, which matches the 20 or 25 year we'd like to get. Might be addressed with some sort of hedging, which would be the way we do it in US dollar, international banks, by raising floating rates, but then being able to hedge for as long as you want. You can hedge 30 year and get a fixed rate for 30-year money in US dollar. It's not currently allowed in the Philippines. I think there's some regulation that were imposed a long time ago when the capital markets in the Philippines was a lot weaker than it is now. But those regulations haven't evolved. They're still there, but you still have that prohibition against basically fixing peso interest rate, which doesn't really make sense. It doesn't make sense for this sort of very long-term interest rate fixing. It also doesn't work for some of these projects that have a long construction period, where you need to be raising money over 3, 4, 5 years project for some of them. Institutionals don't like that. They like an upfront go down for their investments, like bond type investments. And the bidders also don't like that because they'll be bidding for a certain project at a certain date. They might be awarded the project 1 year after that. The government may take 2 years to get the land available, and then you have 3 years to build the project. Meaning that the bidders will have to take a view on the interest rates potentially 5 years down the road. The rates are very low at the moment, but from now on they can only go up, and you might follow what the US is announcing that they'll probably try to look at raising the rates at some point in the future. It would be very nice to be able to hedge those rates if you will say in the US dollar, because you can do that with the normal hedging market. Again, that's not allowed in the current regulation. So the banks would love to do it. They have the products available, but it's just not, they can't give you those products. Meaning that basically the private sector bidders would love to consider some of these very long-term money, but it doesn't make sense for them. They actually would have to incur risks that are too high. Meaning they have to basically take the risk that the rates they get from the local banks will not be reset at a level materially higher than the one they are assuming for the initial period. There's that. We've discussed about FX as well, foreign exchange risk. Again, there are some regulations that make effective hedging of foreign exchange risk actually relatively impractical. It takes a lot of time to get the approvals you need to be able to get hedging for one of these, for any of these PPP projects, where you know that for some of them you have to purchase a lot of the equipment or get contractors from overseas. So we're having to pay them in US dollar over 3, 4, 5 year period. That's another issue. It might actually, looking at institutional, there's a bit of liquidity in peso, and there's actually, I think, about $3 billion of life insurance premium every year in peso, and most of that is in peso, which will give some liquidity for some of the projects. But if the PPP program is successful, eventually you need a lot more money every year. There's potentially trillions of dollars of institutional money available overseas. Some of that could be brought in with the ability to look at hedging the foreign exchange risk that comes from that. I mean, I'll stick to this point, but it's just an example of regulation which is not directly linked to infrastructure, but that's making basically effective financing structure for some infrastructure difficult.
Thank you. Vida, we've heard from Michael in particular the comments around the risk-based charge arrangements for insuring funds. And it sounds like that your team is going through a review process at the moment to look at clarifying when the risk-based charge applies and to what extent. Are you able to share the process or the thoughts behind that and how that process has been moving?
Thank you. Actually, we have a new insurance code. It just took effect. Actually, the amended insurance code just took effect 2013. And so we have been actually formulating the implementing rules and regulations. And one of those is actually the review of the risk-based capital framework. And that's true, really. If the investment is in the form of a loan or receivables, for instance, then it would require a higher capital charge, as is true in other jurisdictions. But PPP is one of those opportunities that we see, especially for life insurance companies, in the sense that really our companies are looking for investment instruments which would offer them a longer term. And we can consider the fact that with PPP being one of those projects that the government is really interested in, and knowing in fact that well, this will be longer term, but then the benefits that it would go to the government, to the people, would be such that, of course, we could imagine how large it would be in the long term. Then maybe we could have some considerations for the capital charge, a special figure, for instance, for capital charge in the meantime that PPP projects are being encouraged, rather funding for PPP projects are being encouraged from the funders, like insurance companies.
Yeah, I guess it's challenging, isn't it? Because each PPP project is different, where you might have availability-based charge, which de-risks the project to a certain extent, or it might be patronage risk there again. So I imagine it's challenging to try to find that spot where you can actually set that risk-based charge for funds. And while I've got you, I guess we've seen in certain parts of North America where some insurance companies have clubbed together to create a fund, an infrastructure fund. Do you think that's something that might be available here in the Philippines, or is there an appetite for that here in the Philippines?
Oh yeah, the pulling funds by insurance companies to fund PPP projects. Well, I'm not quite positive about it because of the the large diversity in terms of the asset base of insurance companies. But maybe a number of insurance companies might just come together, pull their funds, and invest in PPP projects. But say to make it a requirement for all the insurance companies to participate, I think it would definitely be a viable